Ladies and gentlemen, you're highly welcome to the Dicalo Consulting YouTube channel. Dicalo Consulting is a management accounting consultancy firm. We offer consultancy services, bookkeeping services, sourcing of employees on behalf of companies, of financial advisory, internal audit, design of internal controls, as well as to provide professional training to corporates and individuals. Kindly subscribe to the notification channel kindly subscribe to our YouTube channel as well as the notification button so that each time we post a video you will be notified. In this session we're going to continue with capital budgeting. In our last session we learned more on how to evaluate the project using the internal rate of return. In this session, using the net present value. In this session, I'm going to teach you on how to use the internal rate of return function, which has been incorporated within Excel, in order to compute your net present value within a matter of seconds. And I mean it. You will understand that basically, as a financial manager, or as a finance manager, or a financial analyst, or a finance controller, or a chief accountant, or whatever responsibility you may be charged, or if you are working in the treasury or in the capital budgeting department of your company, you may be expected to evaluate or to compute the internal rate of return of certain projects. And you understand that capital budgeting or investment appraisal entails the company investing huge sums of money which are very material in long-term projects, and in order for the company to proceed with these projects, it's always very important that the company should properly evaluate and check whether it's financially viable for them to invest in that particular project or not. And now in this session we have a project here. The question is, calculate the internal rate of return assuming annual cash flows of $55,000 in year one. And so automatically they are trying to make us to understand that we have annual cash outflows of 51,000 in year one and cash inflows of 15,000 or dirhams, because all the values here are in dirhams, so we need to change this USD to AED. So everything here is in AED. Now this is our data. We have presented it in a very neat and tabular format in a way that can easily be understood. Our financial period commences from 2021 to 2030. So it's easy for you to format this. You can, first of all, it's very easy for you to be able to format your date function, and then from there you can add the number of years right up to when you have 30. So basically our financial period starts from 2021 right up to 2030. So we want to evaluate and see whether this project is financially viable or not. They have given us the cash inflows and outflows over the expected useful life of the project, as well as the discount rate or the cost of financing the project. So now we want to compute the internal rate of return. I've explained to you, you don't have a lot of time as a finance manager. You want to compute them easily, as fast as possible, and then you may spend more time on explaining to management how they are going to benefit, how the project is going to benefit the company if you are recommending that they should invest, or why you think they shouldn't invest. I've explained that if the internal rate of return is greater than the discount rate or the cost of capital, it entails that the company should invest in the project. The company should accept the project. However, if the internal rate of return is less than the discount factor or the cost of capital, it means that you recommend your company to reject that particular project. Why? Because if the company invests in this project, the value or the worth of the shareholders will not be maximized. Again, we understand that the internal rate of return, which is denoted as the IRR, is simply that discount factor where the net present value from a project is nil. Which means that at this discount factor or at this rate of return, when you use this rate of return to compute your net present value, at this internal rate of return, your net present value will be zero. There will be no, it will be nil. You will neither have a positive or a negative NPV. Means that the value of the present value of all cash inflows will exactly be equivalent to what? To the cash outflow. So it may be cash inflow 10,000, cash outflow 10,000. Automatically your net present value will be nil, which means that you will be breaking even at that discount rate or at that rate of return. Now let's compute our internal rate of return using the internal rate of return function that has been embedded within Excel. You start with equal to sign, and then you click on FX function, and then you select internal rate of return. You click OK. Very easy. Then the first value there on the function argument, the first one is what? Values of the FR. You select all the values, both cash inflows and outflows, and then they are saying about guess. So you can incorporate any value here, because you can incorporate any value, and then you click on OK. So let's select what? Let's select 2, and then you click on what? OK. So our internal rate of return here is what? 23%. Okay, let us assume that, let us select a number, a random number, or a number even above 23%, and see the results will still be the same. So we start with equal to sign. You click on FX, which is a function, and then you select arrow, which is the internal rate of return. Okay, and then the function arguments there. The first one is what? Values. You select all the values starting with the cash outflows, throw out the cash inflows, and then what? You incorporate the guess. So like I've said, you're guessing this rate of return because you don't know. You're trying to like guess what is the rate of return that if we invest in this project, we are going to neither be making a profit or making a loss. So let's assume that we're incorporating here 30. Automatically realize that we have still had our internal rate of return. So you realize that if you are very familiar with the usage of this arrow function within Excel, it's going to take you just like 10 to 20 seconds for you to be able to compute your internal rate of return. From there you can then explain to management that since our cost of capital here, which is 23, since our internal rate of return, or our arrow is greater than the discount factor or the discount rate or the cost of the capital by 13%, it means that you are recommending that they should invest in that project. While, because if they invest in that project, they are going to maximize the value of their shareholders. The net benefits are going to outweigh the costs that they have actually incurred in obtaining maybe a loan facility or things like that. However, hadn't we computed and realized that our internal rate of return was less than the discount rate or than the cost of capital, it means that you advise or you recommend management that they shouldn't invest in that project. Why are you recommending them? You are recommending that they shouldn't invest in the project because if they invest in the project, the value or the wealth of the shareholders will not be maximized. Kindly subscribe to our YouTube channel at Dicalo Consulting, and also click on the notification button so that each time we post any video you automatically be alerted. We equally recommend that you follow us on Facebook, on LinkedIn, and you equally visit our website at www.dicalo.com. Thank you.